They notice a conflict of interest with their advisor, and it's the fact that they're tied to particular asset classes. Your typical financial plan is get as much assets under management to that advisor as possible, build up these accounts, all using the market. You get stuck in this 4% distribution rule, so you need quite a bit of money to retire. There's advisors that make commission. They're incentivized to sell you certain products. Really, anytime they sell you something new, they make money. There's also the assets under management advisors. They're vested in making you money, but only the money that you manage with them or money that will eventually come to them from management. The third side of advisors, a flat fee advisor, they don't have to discriminate between asset classes because it doesn't affect their bottom line. We want to be vested in a client's net worth and generational wealth instead of, building out a large assets under management portfolio.
Welcome back, everyone, to the Learn Like a CPA show. I'm your host, Ryan, and today we have a very special guest, Mr. Tyler Murphy. He's going to be the first financial planner / advisor that we're going to have on the podcast. And ladies and gentlemen, I'll introduce you to Tyler. Tyler, go ahead and give us a brief background of your situation, what you do for a living, and how you got here.
Yeah, I'm Tyler Murphy, as Ryan said. I'm a financial planner trying to do things a little differently than a lot. My firm is Strong Side. I founded Strong Side on the core principles of doing some financial planning with a different fee structure. So we're looking at flat fees, and we're not kind of tied to any products. So the goal is really to, reach financial independence earlier, maybe without using mutual funds, being tied to, insurance products. We're truly independent. We look at a lot of different asset classes, and we utilize a lot of real estate in order to get that done. Some background on myself is I'm a CFP, got into financial planning about 3 years back, have always kind of been obsessed with it even since I was a teenager.
So one of the things that I get from a lot of clients too is they don't like the financial planners that are in their network because a lot of them are percentage-based asset under management. And what that essentially means is that they get a cut of whatever your portfolio looks like. And if you're investing in real estate, they can't necessarily get a percentage of that. And so a lot of times people struggle to find a financial advisor that's aligned with real estate investing.
Yeah, and that's exactly what I see, Ryan. And that's kind of the conflict of interest is what I call it, is what I'm trying to avoid is, a lot of people, they have a financial advisor they're working with, they're looking to transition into real estate. You go to that, traditional financial advisor that's charging you 1%, and you go to them, let's say John, goes to, his financial advisor and says, hey, I want to, invest $1 million into real estate or $500,000 into real estate. And the problem that advisor is going to run into, the conflict they're going to run into is that if John does take $500,000 or $1 million from that advisor's managed portfolio, is that's going to affect that advisor's bottom line. So that advisor, whether they know it or not, is incentivized to tell John that maybe real estate's overpriced, maybe, interest rates are too high, or it's too volatile or too risky a market, because it's going to affect that advisor's bottom line. Eliminating that conflict of interest and finding a financial advisor, a financial planner that's vested in your net worth, not the assets under management that they have, is truly important in my opinion.
So I looked on your firm's website, and so you guys have 4 key principles at your firm. Number 1 is growing net worth. Number 2, increasing cash flow. Number 3, creating generational wealth. And number 4, which would be my favorite, decreasing taxes. Can you talk a little bit more about those 4 principles?
Yeah, I'd say, the first thing you want to do in any financial plan is increase your net worth. So you could be starting from zero, you could be starting from debt. You want to eliminate all your bad debt first. You want to create emergency funds. You want to start to build up your net worth through, some of the normal accounts that everybody sees, employer accounts, your Roth IRAs, traditional IRAs, your taxable brokerage, and kind of from there is where you're really going to, build out more complex, net worth. You're also going to want to decrease your taxes, as always, Ryan. That's a big thing that you work on. We kind of lay some basics there, but that's a truly important piece of it as well. Some of the other things we want to do is increase cash flow. So becoming financially independent is really a game of increasing your cash flow to replace your current income. It could be at a business you are running. It could be a W-2 income, but obviously everybody becomes accustomed to, a lifestyle that they don't want to diminish, once they leave their W-2 job or their business altogether. And you need to find a way to replace that income. Passively or, actively, loosely active. And we find that real estate is a really good way to do that. So most clients, they start with a traditional advisor portfolio and transition into real estate as they look to become financially independent.
So that's exactly what I wanted to talk about. So when I first started doing planning for clients, it seemed as if a lot of people had a decent sized investment portfolio already before they got into real estate. And what that looked like at the time would be a decent, healthy emergency fund. They had a normal investing account. They were using IRAs, 401ks, taxable brokerage account money. And then they're making the transition into real estate. And what are your recommendations as far as when is somebody going to be ready to buy a property, their first investment property?
Yeah, I'd say, really somebody's looking to buy their first investment property once they've, built up a sizable 401k, their emergency fund is healthy, they have Roth IRA assets, they've had traditional IRA assets, they're they might even be maxing, a lot of those out, and they have a healthy taxable brokerage that they can work with already. Once they're able to, they're really kind of steady from, what a traditional advisor would kind of look like is, all right, let's see what kind of, bucket we can create for real estate. We can start with one property. We can immediately go into a syndicate. We can, buy 2 or 3 properties right off the bat. One thing that Ryan and I had talked about is, make sure, you don't have more than, 1/4 of your total net worth into, a singular project. So if you have, a $1 million portfolio that you're working with, let's not take that whole $1 million and transition it to real estate in one day. Let's start with maybe a smaller project or a mid-sized project. Maybe you have, $100,000, into a project or $150,000 into a project. Being careful. We never really want to go all in. That's where we could potentially get in trouble with, a couple bad deals in a row. But you want to, over time, continually build out that real estate portfolio in order to replace your income.
And I think that is what people are missing nowadays is they have a job, no investing background, and then they go straight into real estate. I believe that's the most dangerous thing that you can do. And oftentimes a lot of people will ask me what my sort of balance is between retirement accounts and investing versus real estate. My personal strategy is I've determined a number that I want to be able to retire with using retirement accounts and taxable brokerage accounts, and whatever that amount to contribute is, maybe it's $700-800 a month. I'm going to do that before I do any real estate investing, knowing that if all my businesses and all my real estate fail, I can fall back on having that brokerage account or I can fall back on having that retirement account. But I believe right now a lot of people are going straight into real estate without having that background of the Roth IRA, the stock market. And we all know that you can earn more in real estate than the stock market, but it's playing the safe game with the real estate upside.
Yeah, and I see that exactly, Ryan, is, when I work with a client, I typically am taking over for another advisor, and they've done a pretty good job in most cases of kind of building up those assets under management, building up those Roth IRAs, traditional IRAs, taxable brokerages, and even the 401k. As time goes on, as these clients get, older, it could be in their 40s, their 50s, their 60s, we really are transitioning out of the market. So a very safe retirement, account in your 20s or 30s, you could have a ton of equity and it feels really good. And it's volatile and that's okay. As time goes on and you become more risk averse, that's where we really want to start transitioning to real estate is really get that up and rolling. Because we are worried about the volatility in the market. If the stock market goes down 50%, that could take, 5, 6, 7 years to recover. if you're doing that in your 50s and your 60s, you're going to be in a lot of trouble. So that's, another point at where real estate kind of becomes that diversification factor, that current income factor. Is we can take this money out of the market, determine the taxes on it, and get that into a real estate deal and create, pretty quickly real income that's going to supplement your W-2 or allow you to leave that W-2 very, very quickly.
So that's something that I've seen with a few people who are late 40s, early 50s, maybe middle 50s, and they want to retire at normal retirement age, right, 59 or 60, but they got less than $300,000 in a 401k. They got less than $500,000 in overall investments. The only way they're going to safely retire or comfortably retire is taking that $500,000, instead of earning a 4% annual rate of return on it, is to take the $500,000 and go make $80,000 to $100,000 a year in real estate with the $500,000.
Yeah, no, you're exactly right there. And sometimes when I see that situation, those are a little tougher to navigate.
Yeah.
The best thing you can do is start early. And I know everybody pounds that idea home, but if you're in your 50s and your 60s and you don't kind of have that million in net worth or maybe $600,000-$700,000 in liquid assets, you're going to have to push pretty hard into real estate, and that's a tough space to be in too. If you're making some mistakes right off the bat, that could be very problematic. If you're not creating that current income right away, that could be problematic. And just like we don't want to solely use the market or any sort of asset class, we're very careful to not over leverage into real estate as well. That's sometimes where we see an issue is maybe a novice real estate investor that tries to just walk into it because they see it on social media that it's easy and it's a very it looks very simple and everybody makes money, where that's not the case. So I'd say starting early, building that net worth up is a huge key that I would hammer home just like everybody else.
So let's talk about some of those different types of accounts that people can use to build wealth that are not in real estate. So we have first on the list the regular 401k, and no, it is not a race. It is a investment account that you can use. Can you talk a little bit about the 401k?
Yeah, so 401ks, they're all through your employer. Sometimes I hear people say, my IRA through my employer.
Yeah.
Are they the same thing? Kind of. They're both tax sheltered. Hopefully your 401k has a match component or an automatic profit sharing contribution. So when that happens, whatever you put in, your employer might match up to 5%. Put 5% of your salary in. You'll get a 5% bonus right off the bat. You can't do that anywhere else. If it's a profit sharing contribution, maybe they put in $2,000 per employee. It's free money. It's really good to use. In terms of what you can do with that money, it's kind of locked away until you're at least 55. There's a rule of 55 that allows you to get the money out. Most people are going to be distributing that in their 60s. While you're employed there, 99% of the time, you're going to be stuck investing in a set of funds that are available at that employer. Once you leave that company, you're plenty of rollovers into other types of accounts. You can even get it into real estate. But while you're employed, you are stuck there kind of growing it, managing risk, investing in equity, investing in bonds, investing treasuries, all via funds. It is a little bit of a higher fee environment, but the benefits that it provides, far outweigh those fees that you're going to pay in that account.
Mm-hmm. And so how is the IRA different than the 401k?
The IRA has much lower limits. So your 401k, you're looking at, this year, $22,500 you can put into it. Your employer can get even more up there, up to, I believe it's $63,000. And your IRA, depending on your income limits, there's income thresholds here. You can put $6,500 into a traditional IRA or $6,500 into a Roth IRA. There are some caveats there depending on your income and if you have access to a 401k. But in general, if you know the rules, there are backdoor Roth IRAs, that you can, put that $6,500 in, even if you're over those income thresholds. And they're generally in, the mid 130s to the 150s. And that goes up each and every year. But it's a tax-advantaged account, tax-deferred account, the traditional IRA, that allows you to put $6,500 in per year. Mm-hmm.
And what about the a lot of people want to know about the self-directed IRA, self-directed 401k. Do you want to explain a little bit about those, maybe even the SEP IRA too?
Yeah, so the self-directeds, they're really interesting. They're very complex, and I see people, they can get into some hot water here depending on what they're investing in. Some people will use it to invest in Bitcoin. I won't even begin to speak about that. Other people will use it to, buy into, businesses passively. They'll buy into real estate passively. So you have your 401k, your Roth IRA, your traditional IRA. And maybe you just left your employer. Let's say John is working at an engineering company for 20 years. He develops a very large 401k balance, and he's always been more interested in investing in real estate. Your traditional your normal 401k, you can buy a REIT. Not a huge fan of those, but let's say once he leaves his employer, he can go and self-direct this 401k or move it over to an IRA and self-direct it. And that means that he can buy real estate passively with these self-directed IRAs through a provider and have exposure to a completely different asset class with a lot of the tax advantages still in place.
So we're still talking about these baby steps before getting into real estate. So these are going to be all your accounts that you guys should be using, in my opinion, the retirement accounts to play the safe game, right? If you're not ready to get into real estate, if you're not knowledgeable about it, if you don't want to buy right now because of 8 or 9% interest rates, I get it. Use these accounts. Do not sleep on these accounts. We talked a little bit earlier about good debt versus bad debt, and you threw out there 8% as a really high interest rate. I would assume that was for consumer or personal loans, right? Can we give people some actionable steps as far as here's the debt they have and which debt they should be looking to pay down versus not?
Yeah, debt is always an interesting conversation. In the past, I've always called it kind of between 5 to 8%. And the idea is that...
Hey guys, just wanted to interrupt the podcast today to let you know about my Facebook group, Tax Strategies for Real Estate Investors. We have over 6,300 real estate investors in the community actively engaging every single day. You're going to learn all my top tips. You're going to get to network with other professionals, and you're going to get to see all the past recordings and all the past posts in that Facebook group. So make sure you join today. It's going to be linked in the podcast below. And now back to the show.
And the idea is that if you can earn a greater return than the amount of debt there is, the amount of interest you're paying, it's technically better to hold on to that debt, make normal payments, and reinvest that difference. Mm-hmm. Now, when we're talking about 8%, we need to find a viable cushion. So are you making 12 to 13% on your investments? That's maybe a viable cushion. Maybe it's 14 or 15% a viable cushion where you're not running too much risk. The lower that interest rate, if we're talking a 4 or a 5%, there's tons of things out there where we can, almost guarantee that you're going to make over 4 or 5% on that investment. Those are debts you want to hold on to forever. People who got mortgages at 3%, 2.75%, you have the best business deal around. You really don't want to pay that down because you're able to reinvest that money that you maybe would have used towards an extra payment, to maybe buy more real estate or buy more in the market or contribute more to your 401k. So, 8% is kind of at the high end. You're battling an 8% interest rate that you have to earn a higher return than 8%. Mm-hmm. Something like a 5%, 4% to 3%, it's really a no-brainer that you want to hold on to that debt and be diligent about investing the difference. And you'll come out, with a higher net worth because of that, as long as you're diligent. If we're talking something like credit card debt, eliminate every last bit of it. If you have any sort of debt in, the 10 to 12, even, 25%, for whatever reason, you want to eliminate all of that debt before you really even begin to think about real estate or even some of the retirement accounts.
Mm-hmm. Now that the 8% interest is very a curious place, because I've talked to people where they want to take out a HELOC on their primary home to buy an investment property, and at an 8% interest rate, plus a lot of times HELOCs are adjustable, so they'll go up in interest rate over time. That spread doesn't work. Even if let's say it's 8% interest and it's fixed and they can make 15% on an investment deal, the time component of that extra 7% is not worth it. In my eyes, it's not worth it to take out the HELOC to run up your higher interest debt to buy a property. I just don't think it works for some people. How does this change for like secured debt versus unsecured debt. Can you talk about that?
Secured debt versus unsecured debt is, secured debt, you're going to have something kind of collateralized. Unsecured debt, it could be like a promissory note. It's completely no holds barred. Whatever happens. Anytime you have an unsecured debt, you're going to have a much higher interest rate, which is, it's tougher to pay. And just kind of as you said, Ryan, the higher the interest rate you have there, regardless of the type of debt, the harder it is for you to kind of combat it and maybe make sense of loaning that money, as you said, in the HELOC. All the HELOCs recently, every time I get the question, it's really hard for me to approve, of a client or a prospect or just a general question from somebody to take on that HELOC at current rates. It's very hard to compete with those rates from a return perspective. And whether it's secured or unsecured, I'm mostly looking, at what the opportunity cost is.
Mm-hmm. So let's use an avatar here. So I'm Joe. I'm married, and my spouse doesn't work. I take home $150,000 a year. I make $150,000 a year W-2. I've been using my 401k. I've been maxed out my 401k, using my IRA accounts. What does that look like for me to get into real estate from there?
Yeah, I'd say, your first steps, kind of starting from the beginning. We want to, get an inventory on everything you've done so far. Make sure you're utilizing a 401k correctly. You're maxing out your Roth IRA. You are utilizing a taxable brokerage, and you have a hefty balance there that, maybe we dig into part of that to start purchasing real estate. While you're building up all these assets, you're building up a healthy emergency fund, you're eliminating bad debt, you're going to want to educate yourself as much as you can on real estate before you do something. Once you're able to do that, maybe you take, a fifth or a sixth of kind of that liquid net worth that you have and start small. It could be a short-term rental that you're buying for tax reasons. It could be a long-term rental because you want to start with something a little more solid, a little more structured, with consistent income. It comes down to an individual's goals is what's most important in my opinion. If you're trying to, retire early or retire in these next couple of years, you're going to have to transition to real estate to replace that income, fairly quickly. Mm-hmm. But in the very beginning, as you start to transition to real estate, it's building out all those retirement accounts to healthy balances. It's building out the taxable brokerage. It's utilizing that 401k. And, easing your way into real estate as you kind of learn the game through practice or, hiring a professional who has, seen 5,000 real estate deals, 1,000 real estate deals to, point out some of the mistakes that you're going to make early and kind of, gain intelligence through their wisdom and their kind of trial and error.
It's so crazy sometimes because I do a lot of coaching and consulting too, and I review a lot of pro formas, and it's crazy what some people leave out in their numbers. You didn't factor that in, or you have a cabin in the Smoky Mountains, but you're not budgeting for pest control or cleaning the hot tub. Some of these things that just come second nature to an expert is the novice is not even seeing that as an opportunity or something to look for, which I think is interesting. So this is kind of a selfish question that I have, but it gets brought up a lot. But what does a typical healthy asset allocation look like for somebody like me who, okay, I have these baby steps, shout out to Dave Ramsey, baby steps going on, but I'm looking to accelerate my wealth building and I want to be able to retire early. What is a healthy asset allocation in net worth, right? So we're talking net worth wise. If I have $1 million net worth, let's say, and I want to break that up between traditional retirement accounts, I'm going to break that up between net equity and real estate, and then maybe just cash or other securities.
It really comes down to an individual's risk tolerance. If somebody's willing to kind of throw risk aside and say, hey, I want to retire as soon as possible, I'm going to have you build to a net worth to transition maybe 50, 60, 70% of that into real estate to create that income, as time goes on. the balance between what sort of real estate that is, becomes the question. How much is long-term and how much is short-term? The short term is more volatile. The long term is more steady. You're probably going to have those long-term renters for a while. It's going to create really good income for you. The short term, your ceiling's a little higher. You might make more on those individual properties, but you could have really bad years depending on the economy. So I would say in your early years, while you're really building, you're going to want, a huge majority of your net worth inside these 401ks, these traditional IRAs, these Roth IRAs, more so the 401k and the Roth IRA and the taxable brokerage than a traditional IRA. But as you kind of are shifting towards reaching financial independence, you have to be willing to take that leap into real estate. And there's an inherent risk in real estate, just like there is the market. We could go back and forth every day. Which one is more risky? The market has a lot of volatility. Real estate has, similar volatility. If you're looking at something like a 2008, both do very poorly. You could have something like in recent history where property, prices have risen dramatically. They're at or near all-time highs, where the market is still well below all-time highs. So that kind of comfortable allocation that somebody is looking for, I would say in your early years, you want to be market centered. And as you develop your real estate skills, your real estate game, you should be transitioning to real estate in chunks, in pieces, while making sure your assets and your retirement accounts remain there. You shouldn't be excessively loaning from your 401k or draining Roth principal to go out and buy real estate. I would tend to avoid that on a consistent basis. If it happens as a one-off, I understand, but don't risk one asset class just to build another faster, is really what I'm looking at. In terms of a golden allocation for everybody, it's really tough to put a number on that. I do really like your strategy that you had kind of mentioned before, is make your retirement accounts whole. So if all goes well, I'll live a good retirement and I'm comfortable with that. But anything I can do in real estate will kind of be my, that bucket that sends me above and beyond. And it replaces that income on top of, maybe a pension or Social Security or, just your typical retirement account, distributions later on.
So this is probably a better question for me, but I want to hear your perspective on what are some of the benefits that, especially from a tax perspective, that real estate provides that a traditional stock market investor, 401k investor doesn't get?
Yeah, I'd say in the very beginning, whenever I meet with clients, is I tell them that I'm tax conscious. My goals are always to decrease taxes. But anytime it starts to get complex with real estate, I always defer to an expert. I'd say real estate at its core, though, speaking broadly, you have a lot of tax advantages with bonus depreciation in real estate, cost segregations, and step up in basis. So an example I like to point to, and why I push people who are nearing retirement into real estate is step up in basis. And my goal with step up in basis is, as time goes on, you could buy $100,000 worth of Apple stock. It appreciates to $1 million. Kind of that day you die in an estate, it gets a step up in basis. So whoever your heir is, it could be your kids, their new cost basis on that stock is $1 million. So you had that growth from 100,000 to $1 million. Where, if you had bought real estate, you could depreciate it and it could have grown to $1 million, and you get that extra depreciation, that step up in basis. Now, if it was 500,000 to $1 million in real estate, and you depreciated that 500,000 to your tax basis to 200,000, you have a much larger step up in basis than you would with just the stock appreciation. Where real estate, you have appreciation and depreciation that you stepped up. That's in addition to decreasing your current W-2. With, if you qualify for real estate professional status, you're going to be decreasing taxes there on your W-2 income, or just offsetting your passive losses. So while you're alive, you can offset income really, really well with anything that depreciates. And as it passes through an estate, you have a much larger step up in basis, where I kind of call it, you get to double dip on the step up in basis and, really create an extra $300,000, $400,000, $500,000 on just $1 million property. that would have went to you that gets passed on to your kids at that
Well,
point.
well, not only that, but in that example of, okay, you bought $100,000 of Apple stock and it appreciated to $1 million versus you bought a $100,000 property. You didn't buy a $100,000 property. You took that same 100 that you would have put in Apple stock and you bought a $400,000 property. And that $400,000 property, so you're able to, so even before all those tax benefits right there, the number one important thing is the leverage, right? And if I'm able to put $100,000 down in Apple stock, I control a $100,000 asset versus if I put it down in real estate, I control a $500,000 asset. And that's super powerful. Another thing that you said there, and I think I just want to explain it to people, is that supplement basis and how important that is. Can you talk a little bit about, because I remember when I first started doing consulting, unfortunately I had a scenario where it was an older couple and the couple's mom had passed away, and unfortunately she gifted them the property into their names before she passed away. Can you talk about a little bit about just exactly how that works and why that's something you don't want to do?
Yeah, in its simplest forms, gifting to your lifetime is a really good thing. It's very rewarding, but there are right and wrong ways to do it. You do not want to gift stock, highly appreciated stock, to your children during your lifetime. Mm-hmm. It's a little morbid, but you could be 3 or 4 years from passing it through an estate. And at that point, you would get that huge step up in basis. It's basically a tax-free gift at that point. That Apple stock, you're handing them $1 million. The real estate, you're handing them $1 million in assets. Where if you had gifted it during your lifetime, you're going to share. You're going to have that same cost basis. So when your child goes to sell that, you better believe they're going to have huge long-term capital gains that they're going to, have to pay on that. You're also going to encounter gift taxes depending on the size of that gift. In its simplest form, I just tell people don't do that. We'll find other ways to gift during your lifetime. An estate provides a lot of tax benefits, a lot of step up in basis that prevents your kids from paying taxes. So don't gift that highly appreciated stock or those highly appreciated assets during your lifetime, because it will cause a tax headache for them down the road.
What are some of the other mistakes that you see real estate investors make?
I'd say one of the biggest mistakes I see real estate investors making is losing liquidity. And when I say losing liquidity, they might not, manage their portfolio in a way that, they could end up with a fund that's appreciated 99%. And because they didn't do tax loss harvesting each and every year, and it's going to have a large tax, you're going to pay a lot of taxes to get rid of that fund to transition into real estate. I'd say the bigger issue that I see is if you lock yourself into some sort of permanent insurance and the idea of infinite banking. Those products, whether it's an IUL or a whole life policy, they have their uses, but they shouldn't be considered infinite banks. And when people fall in love with that idea, they find that the cash value doesn't grow as quickly as they want it to. It might be year 10 or 12 before they start to, see some of that real cash value, and then they start loaning from that money. When they loan from that money, that interest is paid back to the insurance company, not back to your policy. So is it an infinite bank? Are you banking on yourself? No, you're taking a collateralized loan from the insurance company, just like you could with stocks, just like you could with real estate. So that infinite bank, that idea is you're just taking a loan with a collateralized asset. That's what's happening. And when you lock yourself into those premiums, there's severe tax penalties from surrendering them, or there's a surrender charge. And what I find most of the time is that somebody who's a real estate investor falls in love with the idea of infinite banking, and they lock up all their liquidity into these policies, or enough of their liquidity into these policies that prevents them from buying future real estate, because that loan from the policy at the end of the day doesn't seem too beneficial, and the cash value doesn't grow as fast as they would have liked it to. So I'd say the biggest problem that for one reason or another, is people make the mistake of losing liquidity. And that prevents them from leveraging into real estate and being able to replace the cash flow that they need from their W-2 income.
Mm-hmm. Well, not only that, but a lot of the insurance companies that I've seen, they they recommend people to cash out of their 401ks to put that into the infinite banking strategy. And you're paying your ordinary income tax, which you're probably in your highest earning year. So your 30% plus marginal tax bracket, plus you're paying the penalty, the 10% early withdrawal penalty, and you're probably paying state taxes too. I had somebody that I had to tell to jump off the cliff that was about to cash out an $800,000 IRA and put it into infinite banking. She would have lost half of it just by cashing it out.
Yeah, it's very simple. Do not cash in your 401k for an annuity product or a whole life or an individual universal life or an index universal life policy. Don't do that. You're going to pay a lot of taxes. You're going to give up liquidity. You are going to give up control of those assets. Is there a time and place for those types of products? Yes. Are they right for 99% of people? No.
Right.
If you're in retirement and you're extremely risk averse, you're extremely fearful of real estate, extremely fearful of the market, can you get a almost guaranteed product in something like an annuity? Absolutely. Are you going to get life insurance at that point? Yes, at a very high cost. But no, if in most cases, it's do what the rich do is kind of how they're sold. The rich people do this. You should do it. Those rich people didn't get rich by buying a whole life policy. You need to get rich independently. That is not, your savior end all be all account. And definitely do not cash your retirement assets to buy these products thinking you are going to create some, banking syndicate for your family.
Mm-hmm. So talking about sort of what separates your firm from a typical financial plan, can you talk about that, a typical financial plan versus a strong side financial plan?
Yeah. So, the typical financial plan that I see, let me preface it with this is when somebody hires me, I'm usually their second advisor. They've had an advisor for 4 or 5 years. They've done well. But they kind of start to see it's, just kind of recycled mutual funds. They're utilizing their 401k to the match. They have their Roth IRA and things like that. But they notice a conflict of interest with their advisor, and it's the fact that they're tied to particular asset classes. So your typical financial plan is, get as much assets under management to that advisor as possible, build up these accounts, project out your contributions, project out your investment returns, project out your retirement distributions, all using the market, all using, treasuries, all using bonds and de-risking as time goes on. You get stuck in this 4% distribution rule. So you need quite a bit of money to retire depending on your yearly spend as a family, as a couple. A typical strong side financial plan is going to not build your assets under management. It's going to build your net worth. That's going to be utilizing all those same accounts, plus creating real estate sinking funds, building real estate over time, and understanding that, we want to be vested in the client's net worth and generational wealth instead of, building out a large assets under management portfolio. The other thing I would say is there's different types of financial advisors and how they charge fees. And when I say that, there is essentially 3 types. There's advisors that make commission. They're incentivized to sell you certain products, turn over your portfolio, and they, really anytime they sell you something new, they make money. Mm-hmm. And in all the CRM software that's out there, you'll see that they have a lot of current client opportunities. And those current client opportunities means there's something different they can do with you, whether it's, really good for you, best for you, or just good for you. But they will make money off of making that change. There's also the assets under management advisors. That's kind of the next step. The assets under management advisors, they're vested in making you money, but only the money that you manage with them or money that will eventually come to them from management. Mm-hmm. The third side of advisors is, you could have an hourly advisor or a flat fee advisor where they don't have to discriminate between asset classes because it doesn't affect their bottom line.
Right. And you guys are flat fee only, right?
That's correct.
Okay. Well, thanks for coming in today. Where can listeners of the podcast find you?
They can find me on my website, strongsideasset.com, and we're also kind of setting up an Instagram. It's going to be under Major League Finance. We're going to be putting a lot of really good content out there, just with financial education on these different accounts, education on some real estate, and really our goal is to put out as much education as possible to help people reach financial independence earlier, get them started on the right steps, rather than allow them to make these mistakes that later need to be undone. I would say those are by far the best places to reach me.
Awesome.